big distance as you're kind of out in the Midwest, Joey, with what was it? What you all on? I'm just making sure that we're online. All right, yeah, we are. All right, sweet. Yeah, just want to make sure we're all good. But yes. So currently separated by the Midwest to DC. Given you're out in Milwaukee, right?
That's
Milwaukee.
Exactly right.
Yeah, repping the swag out there, which I love. But everyone, this week we're going to be going back a little bit to our roots and just answering some questions that you all have had over the past few weeks that have come in through email, chat, whatever it might have been. And so we can just take it right off the bat. I guess, Joey, big week this week as it relates to our current properties, with the Roman having just completed its first month of operations and absolutely crushing the returns that we had even projected. So walk us through what happened there. How did it happen? Why is it that this is something that is just absolutely incredible?
100%. So record-breaking week for the first stabilized week of operations at the Roman, as Alex mentioned. Ended up spreading across 6 different bookings for the month of March that we paid out for. Everyone should have received that first kind of 0.9% cash-on-cash yield from the first payout that we did earlier this month. So for context, if you invested $10,000, that would be about a 1% yield on that. So what is that? $100. And so this week we actually ended up paying out an additional 1.7% on top of that, which would result in a 2.6% cash on cash yield just for the month of March, paid out in the month of April. Annualized, that would look like a 31.2% annual yield before appreciation, which is just outstanding. For context there, if you would have invested $10K, you would receive $260 this month, or $3,120 for the year. So just a great start. That was only the first month. We're obviously in spring now, and the hot months are typically the summer months, pun intended. So you'll see a lot more bookings coming online kind of through those months, and this is just a great way to start it off.
Yeah, I mean, absolutely ridiculous, the fact that 2.6% in its first month. I mean, that blew away any sort of estimate that we even had for the property. That is just absolutely ridiculous. It speaks to, obviously, the management team that we have in place, the property selection, everything that happened there. So, I mean, just absolutely great to highlight. There still is actually investment available in this exact property. If you go over to mogul.club, www.mogul.club, you can start out with as little as $250, get your feet wet. This is the Roman again. So outside of that, I mean, if we're going to go more broadly speaking, one of the questions that we get asked quite a bit are, what are some of the trends that you are seeing in the housing market? I mean, Joey, do you want to take that? Do you want to walk through kind of what you've been seeing on your side, especially on the supply inventory, especially with the different operation strategies that you can implement in the SFR markets?
100%. I mean, so I was actually just going through yesterday, refreshing all of our market data as we look to launch a couple of pretty cool new features on the site itself. But just seeing the kind of trends over the past 5 years in a lot of our target markets, especially when it comes to like the Houstons, the Dallases of the world. We've been keeping a close eye on Nashville, Atlanta, Birmingham, Alabama is actually a hot spot right now. A lot of the fundamentals are just outstanding. We're seeing around like 6 to 8% annualized appreciation from a capital markets perspective, and then the operations side, we're seeing standard like 3 to 5% annual escalation in top line rents, which is just great news. A lot of the properties that we currently have exposure to in those markets are performing really well, as shown by the Roman. This week, obviously in the news, you might have seen that mortgage rates are kind of topping out for the year right now, around that kind of 7% plus range. So hopefully we see those come down soon. Regardless, we're on top of it with our kind of market agnostic strategies here. You'll see the second of its kind, actually, after the Bowser come online here. It's going to be called Lakeside. That's going to come online, and that's going to be the first of that sale leaseback model that we've talked you through before. So a lot of cool trends right now. Keeping a close eye on its target markets. I think we'll see a lot of that escalation from a rent growth perspective and appreciation perspective continue over the next few years, especially given buyer frenzy.
Yeah, no, I completely agree. And I mean, not to mention that just goes to show you too, with everything that's going on with those 8%. I mean, it's 8% too. It is just the mortgage rates right now are just absolutely egregious. It's just come at a time when everyone is freaking out. It was the day after the inflation data came out, everyone started freaking out and starts going up 25 bips per day. And then the minute that Jay Powell came on and said, we don't even know if rates are certainly going to be cut by the end of the year, it just absolutely blew everything away. I mean, it's kind of ridiculous. But yeah, outside of that, that's one of the major trends that's going on in the housing market. In addition to that, that just feeds into everything from the supply and demand dynamics. So if you were looking at from the supply side, a lot of sellers are looking to hold off on listing their properties because they're locked in with golden handcuffs, which we probably will go through a little bit more later on in depth. And they aren't looking to move, but some are being forced to move. So there is a dwindling amount of supply. I know out in DC, there's about 4.5 months of inventory on the market, which means that's the amount with the average sales over the last little bit, how much it would sell out if all the inventory were to be sold down. 4.5 months. When's the last time you saw 4.5 months of inventory in these past few housing markets? It's just ridiculous. And so it just goes to show you that like the supply is not matching up that well, and the demand is faltering a little bit, and people are holding back. The previous open house showings that would be 6 to 10 offers within the first hour are now actually dwindling to the point where they won't even have an offer following an open house. So it's ridiculous, the market dynamics now. But outside of that,
Definitely.
let's get into our favorite topic. What?
Yeah, hit us. I was just gonna add too, like a lot of the kind of average day listing trends that you'll see in our target markets are still hovering around like that 30-day kind of 30 sub day trend, which is wild because you're 100% right, Alex. Like a lot of the inventory on the market right now just isn't aligning with buyer demand, especially just with the artificial swings that have happened over the past couple of days. So very curious to see what's going to happen there. Good news is it's still great for our fundamentals, right? Because it's still cheaper to rent than own, which is just a wild concept. Unfortunately, but also fortunately, it's going to drive a lot of great outcomes from an investment perspective. Platforms like Mogul are going to increase the opportunity for retail investors to break into that market. Obviously, a lot of it is cornered by institutions right now, controlling that own and then charging those rents and escalating those to hit that yield on their cost basis. So hopefully we can continue to facilitate that swing for everyone.
Exactly, and definitely some properties on our platform that made the leverage accretive and even today's interest rate environment. I mean, we originated new debt for that Roman, and the fact that it's at a 31% APY. I mean, within its first month of operations, obviously, I'll caveat with that. It's just ridiculous, even with the debt in place being around 6.5 for that one, or 7 was the interest rate on that. So absolutely ridiculous. So one of the questions that we get quite a bit here is like, what are the tax benefits of real estate? We listed out on the website, and there are a few different perspectives that we can look at it, right? It's the cash flow, the exit, and the estate perspective. And so I'm happy to dive into a few of them. And then Joey, you can course correct me. You can correct anything that I might say that's absolutely egregious, and then we can go from there. But
perfect.
If you look at the cash flow perspective, a lot of people question us and say, well, versus a REIT, or just what are the tax incentives associated with real estate? And on the cash flow dynamics, if you look at it from that perspective, the IRS wrote the tax code to incentivize home ownership. And so with that, they created something called a ghost expense in the form of depreciation. And so the idea being that the structure of the real asset itself will start to deteriorate over time, even as the value is increasing because of the market dynamics. And so because of that, you can take that depreciation and put that against any rental income and cash flow that you get from the property to protect you in the event of taxes. And so how that looks like, as an example, is a property, let's say it's a $1 million property, 60% of it can be attributed to value that it can be depreciated over a 27.5-year period. Now you can take a rental income minus your operating expenses, minus your interest, tax, and insurance to get to your taxable income, but then you also subtract out that depreciation. And so that depreciation, which is that 600K, which is 60% of the million, divided by 27.5, I believe it's around 21K. I just ran the numbers, by the way, yesterday. That's why I know it. It's not that I'm doing it on the top of my head. But anyway, 21K.
Oh, you've done more complicated math than that from the top of your head.
So they put that against the rental income, and that actually, if you're looking at an 8% yield on a cash basis of like 200K, that means that it is a pretty significant tax loss. And so that depreciation basically stands against your rental income for the purposes of IRS reporting, is a taxable loss, a passive loss that you can put against any other passive income that you might receive. But that 8% yield that you're getting is actually sitting in your bank account, which is absolutely ridiculous. And so I don't know, Joey, is there anything else I missed from the cash flow perspective?
No, that's 100% right. I guess also I would ask on top of that, like, what is the benefit of actually being able to achieve those potential, tax benefits that come along with owning that real estate versus other platforms that typically like to scrape them off the top potentially, or don't even pass them along at all?
Yeah, I mean, if you look at even a REIT, right? If you were to get a dividend that's passed out from that REIT, or even in the platform that doesn't get the tax benefits associated with it, let's say it's a 10% yield. Let's say for the purposes of everything, you invest $1,000, you're getting $100 back in cash from the dividends being paid out. Now, if you were to compare all things being equal, our platform versus another platform, that 10% in another platform quickly becomes 5 to 7% post taxes, because you're actually going to get taxed on that amount. Now, for us, that 10% stays a true 10%. And on top of that, you might actually receive a passive loss for the purposes of IRS reporting at the end of the year. And so you can slap that tax statement that we provide directly into your portal on the back of your tax returns and get a little bit of a help, if you will, against any other passive income you might receive. So 10% stays 10% with us, 10% becomes 5 to 7% with any other platform that's doing it without tax incentives. So absolutely ridiculous there. But then one of the questions we get all the time is, well, what about the exit? Obviously that depreciation tax has to go somewhere, and there's depreciation capture at the exit. So what happens then? I mean, if you want to talk through, I can talk through. I defer to you, Joey, if this is something you want to touch on or not.
Yeah, hit us with the conceptual knowledge, and then I'll talk through how it directly relates to the platform.
Conceptual, real estate, again, was made with taxes in mind, and the IRS wrote the tax code to incentivize this home ownership. So conceptually speaking, there are a number of exit strategies that you can do to mitigate that tax exposure and at the end of your hold period. Number one, refinance. Refinancing, it was all the rage in the past few years as interest rates were low. And that means you can actually take out new leverage against your property and basically cash out part of your equity in the property at this new asset value at the mark to market. And so when you refi and you cash out part of that equity, you actually don't receive any tax. You don't have to be taxed on that cash out amount. I mean, Joe, you did a refi a few years ago. How incredible was that? The fact that you can just pull out like an ATM cash from a property.
Incredible. I was obviously aware of the proceeds being non-taxable, but wasn't aware of the benefit of it at the time until you made it very apparent to me, which is awesome.
Yeah, I mean, that if you had 100K, that 100K just became 100K. It's not taxed to 50K. That 100K can be deployed on Mogul or in other properties. That's number one. 1031 exchange, a little bit more complex, obviously, but it's basically if you sell out of a property, when you sell out of that property and you buy a like property, and by like property, I mean like capitalized property, you can actually take the proceeds that you received, and within 90 days, I believe is the time period, you can go out and buy a new property using the proceeds and completely avoid your cap gains tax on the proceeds from the previous property. So you can just leverage that directly into a new property. And then the last one that I'll speak to, and then I'd love for you to touch on how it relates to the platform, is the estate perspective. So this is one of the most ridiculous things that I was absolutely blown away when I heard this, is the fact that when you pass your asset, when it's passed along to your next of kin, is marked to market for tax perspective, the cost basis of the market value. So let's say you buy $1 million property, 30 years later, you pass away. I mean, hopefully it's longer, Joey, in our case, but like 30 years later, let's say you pass away and it's worth $2 million. Now, if you had sold it you would be taxed on that $1 million in between. But your kids now receive that $2 million property. And if they were to go and sell it the next day, their cost basis in it is $2 million. So they're taxed as a non-gain. So with real estate, you just buy, hold, refi, 1031, whatever it might be. And then your kids get the benefit of selling it without having any sort of, I mean, that's ridiculous to me. But anyway, those are the three main exit perspectives that you can look at. But how does it relate to Mogul?
Yeah, 100%. I mean, first of all, deferred tax is just outstanding, right, on cap gains because one, that compounding of the value that you continue to achieve and the return on your equity invested in the real estate is obviously going to be strengthened by that value proposition of not having to pay those taxes, hurting your return, hurting your cash flow, earlier your investment cycle, which is outstanding. As that relates to the Mogul platform, right? So our investments are structured as property company LLCs, right? These are investment clubs. So there's one property company LLC that holds the title, the limits of liability, the guarantee, all of that of the real estate. So one property company LLC for one real estate asset. And the way that that works is we issue the equity in those property company LLCs, right? So when you're thinking about the LLCs themselves, they're pass-through entities. It's a partnership. So you'll receive those tax benefits via forms that are directly downloadable from your tax portal at the end of every year, this year being the first year that you'll actually receive them. Super exciting stuff. There's a lot of complexity as to how exactly that works, but we have an outstanding accounting team and really look forward to passing along those tax benefits.
Couldn't have said it better. Yeah, I mean, that's the beauty of real estate, right? Why do you think Donald Trump doesn't pay taxes? Or that's like whenever anyone asks, like, oh, how do they not pay tax? It's real estate. Like a large majority of it is real estate, and so that's great. But anyway,
especially with those losses that he was achieving.
Yeah, I mean, maybe don't go that far out there. But all right, what is happening with interest rates? Joey, talk us through it.
Yeah, so we kind of talked about it. Interest rates are topping out. Depending on what kind of loan you're taking out, it really depends whether it's more of a conventional 30-year fixed. We are seeing rates topped out right now again around that high sevens, 8% kind of right now. Usually if you're taking out an investment grade loan, you can add on an additional kind of 0.75 basis points to a point on top of that, which only increases your barriers to enter, right? So what are we hoping for kind of by the end of the year? We've been promised some rate cuts here. We're getting into Q2, waiting to see what's going to happen there. But, as we've mentioned before, we're working on a lot of really great market agnostic business plans that are going to be implemented on various properties throughout the platform that will directly counteract this. Now it's a win-win scenario because if interest rates do come down significantly and they start to swing over the next few months, we will see a lot of benefits when it comes to our ability to capitalize quickly on a lot of our short-term and long-term rentals that we dearly love and are, great kind of, minimum 12% hurdle rate as we like to advertise on the platform. So you'll see a lot of that product come online over the next few months. But in addition to that, we're really, really excited about this sale leaseback model that we're doing now. And we'll have a lot of focus around that until we do see those rates move. So, defer to you, Alex, on what your opinion is on when those rates will actually come down. I'm still very bullish. I'm hoping it'll be soon. I know you and I are in the market now for our own personal property as well, but we do have a couple tricks up our sleeve potentially there that you're working on now. If you want to talk through that, it's a pretty cool story too. But curious to hear your opinion.
Yeah, I mean, personally, the 6 interest rate cuts that's done. That's dead in the water, in my opinion.
Yeah,
like it would have happened already now. It was incredibly optimistic to think that it would just be immediately down to 6, even though we hadn't even hit the inflation target inflation of 2%. The fact that we were still hovering above 3 and they were like, no, it'll be cut down by 6 by the end of the year was egregious in my mind. I don't know what analyst fat fingered that one, but not going to happen. So I think 2 or 3 by the year end might be a case. I also could see a world in which it kind of holds off for later. I mean, the economy is just ripping. it's the reality of it is in the next few days, I think it's the 25th, April 25th is when we're going to get another reporting on like at least the GDP. And so it's kind of ridiculous to think that it's going to slow down even a little bit when the unemployment rate is so low, the optimism around the stock market is so high. Some stocks are starting to come down a little bit to earth, but they're all still hovering around all-time highs. I mean, Tesla's getting hit a lot, but that's kind of just because people are realizing that it's a car company, it's not a tech company. So that's that. But I would say interest rate cut by the end of the year is possible. I wouldn't ever kind of put my neck out and say that it's 100% certain, but I would say like maybe 1 to 2 by the end of the year is my base case assumption, and I can see them going down even by a whiff that they'll be down by the end of the year. So it doesn't hurt our properties because we locked in great mortgages. We have a pipeline of these circumventing due on sale clause properties, and so for us, I mean, it's only great news if they come down because that's just going to boost appreciation. A 30% APY on a property like the Roman is, with the ability to still buy into it now, is at the basis is ridiculous in my opinion. So
100%. And again, I completely agree with everything you said, by the way. And again, on the Roman, like the wild part is that's pre-appreciation, mind you. Just want to like stress how wild that is. So obviously, when it comes to real estate, right, you attribute value to mainly two pillars, tax benefits, potential tax benefits aside. It's going to be that the operations and capital markets, right? It's going to be your rent, and then your rent post expenses and post debt service, and then also the appreciation that you're achieving on the back end, which we make liquid in real time with our platform. And so what we're seeing now is typically you attribute, what would you say, like maybe like 60 to 70% value accretion generally to that appreciation, and like the other 30 to maybe like rental income usually, right?
Yeah, I'd say that's a pretty good amount. Yeah, it depends.
So
it depends on the strategy.
It does. It completely depends. Yeah, 100%
with our rental strategy, I mean, it's kind of like 50-50. But like with long-term rental, it's probably like 20-80.
No, 100%. So even just contextualizing that, let's say conservatively, we're talking about 50-50 from like a standard, baseline business plan. That 31.2% potential annualized return that we're streamlined, straight lined on track for the Roman, that's only on, again, that rental income. So the appreciation on top of that, let's say, well, just to contextualize it now, obviously that one appraised around 7 to 8% above where we bought it at cost basis. And you'll see that first mark to market happen the second that's sold out. So continue to invest. You'll see that, happen very soon. But in addition to that, that appreciation value that you'll look to achieve as a massive part of your return, potentially 50% of the value accretion on your return, is going to be matched with that income that we're seeing right now, right? So that's another potential, 30% of appreciation return just from the first year, right? I mean, you're thinking about that 7 to 8%, and we're thinking about, I think we closed around, 80%, 75% leverage on that one. That's a 4x on that 7 to 8% appreciation multiple that you're potentially achieving per year. So, that's whatever, 28 to 36. I mean, that's 32, 28 to 32. That's pretty significant. And that's before, that income that you're achieving now is before that appreciation. So just pretty wild to conceptualize.
Absolutely ridiculous. And that's just the Roman. So go check it out at mogul.club, www.mogul.club. Still, you can invest in it still today and still be receiving the same cost basis. And so outside of that, next question is, what's the difference between a REIT and Mogul? Just wrote a blog on this. We just posted about it recently. I can jump into it, but for those of you all that are not familiar, REIT, Real Estate Investment Trust, commonly it's thought of as the only way to invest in real estate with a lower barrier to enter. I do not agree. I think that it was largely one of the biggest marketing circumstances to sell real estate to everyone, to the masses, without actually giving them real estate. It's kind of like got milk, like they tricked everyone into thinking that they're getting the benefits of vitamin D or vitamin C, whatever it was that had the milk, but it was like, they're not investing in real estate. A REIT, basically the way that it's structured, real estate investment trust, is a 75-75-90 rule. 75% of the assets have to be held in real estate or cash flowing, income producing real estate assets. The second one is 75%, half of the income has to be from the real assets themselves or the financing around it. And then the third one, 90% of that cash that comes from the rental income has to be distributed to the end shareholders. That means there's only 10% left to reinvest in new properties. And so they're not actually getting any of the appreciation associated with the properties or even adding on to different properties. But then the second one, that 90% that's distributed, that's taxable. So exactly what we had said earlier, a 10% yield on a REIT versus a real asset. In a REIT, the 10% becomes 5% because the shareholders tax on it. In a real asset like us, if we were to invest in a fractional investing platform like us, that 10% stays 10% because of the tax benefits associated with it. So it's kind of ridiculous to think that REIT is any sort of real estate investing because it's very vanilla, it's very bland. They have target yields that they have in place. There's an asset management fee that you get gouged on. We have a great blog on this that we just wrote this past year or past week. Sorry, it just got launched. But
time's flying.
Yeah, I mean, yeah, I hate REITs. I think they're an egregious lie to the consumer. But anyway, that's just me. I don't know if you have any more of a better tempered, even tempered view on REITs.
No, I couldn't have said it better myself. And Big Dairy always tricking us.
Big Pharma.
No,
yeah,
I think Big Pharma, Big Dairy. No, I think that ties relatively well into like the discussion of relative cost of capital, right? It's like when you're looking at different investment scenarios, different options of what you could potentially do with your money. There's typically you think, public equities, like, can I go and invest in the stock market? Can I go and throw it in a high yield savings account? Maybe I'll invest in treasuries, which actually surprisingly a lot of consumers just generally don't. And conceptualizing that to what is your relative cost of capital, right? When it comes to a platform like Mogul. So our minimum hurdle rate is a 12% IRR, right? So we will literally pass on any deal that is not underwriting in a bear case scenario on the platform to at least a 12% net return on your money. So if you're not making at least $12 on your $100 invested every year from a mix of appreciation and rental income, post expenses and post debt service, we're not even going to consider it. And so when you're thinking about that relative cost of capital, right, as Alex just explained, if you're targeting on a good day, 5 to 7% in a REIT or, 7% annualized in, say, the stock market, or 2 to 3% in a high yield savings account, or any other investment opportunity that you're looking to make, that relative cost of capital is something that you're going to have to, pit against each other, right? It's all relative in terms of what option you want to make and then the risk associated with it. Luckily, as history has proved to us, real estate is, generally speaking, the least riskiest. I would argue the least riskiest investment, objectively speaking. So when you're thinking about pinning it up against even like commodities or equities, Alex, you're the resident expert. I mean, like, how much should I be allocating towards real estate generally?
So principal school of thought is about 20 to 30%, kind of in that range, should be allocated in the traditional portfolio. And this wasn't even my doing. This was sorry, Joe. This was a Yale economist, CIO, that basically put this in place. That back in 1985, I believe it was the CIO of the Yale Endowment said, let's allocate at least 20 to 30% of our portfolio to real estate. Typically, the principal school of thought was 60-40 portfolio mix. That was kind of the overall policy for portfolio, and 60% to 60. Oh God, I'm mixed. 60% stocks, 40% bonds. And so with that, he came in, let's do 50, 30, 20 with 20% to real estate. And so when that happened, it actually outperformed every other endowment to date. It became the de facto method. Between that and between 1985 and 2021, we have it on our site. It just completely crushed any other portfolio strategy to date. And it's because the fact it's a perfect mix of stability, cash flowing assets with equity appreciation upside. And so it acts like an equity, but it prices out like a fixed income asset. And so that's kind of the beauty of real estate, is it adds that stability, but it's like a bellwether. It stays constant throughout your entire lifespan. So that's great. I mean, obviously, notwithstanding the 2008 bubble, like we obviously like to say that, but it's at the same time, it's if it's priced correctly, if there's not a bubble in play, it's kind of the best asset for you. So that's our 2 cents, and definitely if you want to check out how to invest in real estate, you can go over to our website and check it out. And it's pretty easy to do. $250, you can get started out, dip your toes in it, and then come back later when you start realizing just how great real estate is. So that's that. Let's see. We have what is happening. I'd love it if you could give a brief update on what's going on with the Logan and the Kendall. We touched on the Roman, obviously, on the record-breaking 1.7% cash on cash yield for an additional 1.7% cash on cash yield for a total monthly cash on cash yield on the Roman property of 2.6 annualized to 31.2 before appreciation. What's going on with the Logan and the Roman or the Kendall? Can you just walk us through high level how each of those is performing?
100%. So we have those fully up and running, stabilized, listed on Airbnb. Bookings are already flowing through. You should have gotten an exciting email with the listings themselves. I personally am already going to be booking a stay at the Logan out in Ukaipa when I'm there later this year. Super excited for that. So right now, we have those in stabilized operations. We're working with our property management team over at Awning. And essentially right now we're already seeing bookings in April covering our debt service to be paid out in May. So any overages over those expenses and debt service that we receive in that rental income will be distributed directly to your account, pro rata to how much equity that you currently own. Right now it is outstanding because you can still invest in those properties at the cost basis that we bought it for. That will not change until they're fully sold out and we can mark to market them on the platform. And, both of those, again, we're also appraising around that. The Logan was actually around 7% above where we bought it for in terms of where the appraisal came back. And then the Kendall, to be perfectly frank, is already around like 12% in terms of appraisal value around where we bought it for today. So you'll see some great upswings in the market there. Again, we're allowing you to invest at the cost basis where we purchased them for on platform. And so, just great updates. The market fundamentals in both of those markets, as I was again updating the the fundamentals from a capital markets perspective and operations perspective yesterday are still looking outstanding. We're really bullish on the Inland Empire. We're really bullish on both Houston and Dallas, Texas. Dallas, where the Kendall is located. Especially over near Lake Hubbard. Alex and I have been there multiple times. Great lake to hang out. Fully amenitize both of these properties. There's a great hot tub at the Logan. Incredible pool and backyard at the Kendall. And then if you just go and check out the listing at the Logan, it's probably one of the most beautiful properties I've ever seen. I think our head of marketing Thomas was joking about it the other day that it just so eye catching. He uses it for a lot of the kind of cool looking pictures that we need elsewhere. It's just such a great model property. But anyway, quick updates there. You'll see some more concrete updates come over email and through the platform over the next few weeks.
Yep. No, that's very much looking forward to kind of these updating people. I mean, obviously it was well worth it with the Roman, so it'll be very well worth it for the Logan and the Kendall. I mean, if people want to get involved now and get the access to those emails, they will be, but very much looking forward to that one. So one of the things that's kind of been a trend in real estate is this Airbnb arbitrage. And so a bunch of people have been asking us, what is Airbnb arbitrage? Obviously, it's not directly related to our platform to date, but I can just touch on this. It's kind of think WeWork meets Airbnb. It's the idea, it's basically slicing and dicing up a lease to generate more yield. And so long-term rentals versus short-term rentals. Short-term rentals, because it's higher turnover, higher risk, higher vacancy, is actually a higher yielding asset because you price things on an average daily rate, an ADR. Now, with a long-term rental, obviously you are severely mitigating against any sort of risk because it's a long-term rental tenant, right? You sign on for a year. And so basically you're guaranteed X amount of income each month from a rental tenant. Now, so what a lot of people are doing is they're identifying these assets that you can actually sublease out your apartment or your house, whatever it might be, and sublease, cut it up, and basically Airbnb it out. So it'd be like you and I would go rent out a single family rental home. We would rent it out on a long-term tenant lease. Let's say it's $2,000 a month. Now you and I would then go about furnishing it, getting it rent ready, listing it on Airbnb, VRBO, Booking.com, and we might get 4K a month in rent from that. And so that 4K minus the 2K, that's that arbitrage that's happening. And so because we're willing to take the risk, because we're willing to kind of go out there and make it so that it's rent ready, manage it on a little bit more of an arduous or hands-on process, that's what Airbnb arbitrage is you're leasing it for one thing, but you're actually renting it out for another. It's the exact same WeWork model where they lease out one thing on a long-term tenant, slice and dice it up, and say sell day passes out to and office tenants. So that's kind of it. But people were asking about it, so I thought we'd add it to it. And that kind of leads me into my next question, kind of golden handcuffs. What are they? Can you walk us through what's been going on in the last little bit?
Yeah, golden handcuffs generally. I mean, so are we relating this just to the real estate market?
Yeah, just in general. Yeah.
Yeah. So, I mean, the concept of golden handcuffs, right, is being essentially locked in because the value proposition of what you're doing now is better than the value proposition of what you could be doing if the grass is greener on the other side. So, well, maybe you walk us through like what you typically attribute the golden handcuffs to in real estate, and then I can walk through the additional math behind it.
Yeah. So golden handcuffs in real estate, if you're thinking about it, over the past little bit, when debt was pretty low and you could lock in sub 3% mortgages, you lock them in there for 30-year terms. And people thought that this would happen forever. And so they bought these ridiculous homes that were either really big or just were kind of out of their price range if mortgage rates were to come swing the other way. Now what we're seeing is a lot of people are locked in at these rates that are sub 3%, and they don't want to either downsize or sell and have to go to a different property. And when they go to a different property, they're going to lock in a rate that's around 8% versus the 3% that they locked in previously. So it's golden handcuffs because, yes, it's incredible. They have this 3% mortgage, but they can't move. So they're locked in place to that individual property. They have equity in place. They want to cash out on it. But if they were to go take that and deploy it into a new property, they're going to do it at a higher rate. And on a monthly basis, it's almost untenable, and they can't afford the same that they would previously. So they're stuck in place. It's created this weird dynamic with a lot of people bringing supply online, but only doing it hesitantly. And really just this dynamic is prevailing right now. It's going to prevail for the near term. It's going to create a ridiculous market in the near term when short term or when interest rates come down. But that's just kind of a high level overview. If you want to walk us through math on that.
Yeah. So yeah, 100% no. So the thing that's great is a lot of the inventory that we're seeing right now and a lot of the pipeline that we're using, especially for the sale leaseback model, comes directly from sellers that are in the predicament that Alex just described. So essentially, if people are locked into great mortgage rates and are kind of just sitting there with, probably decent amounts of equity locked up as well, if they have favorable mortgage rate, that would mean it was originated in a much friendlier credit environment, which, as we've seen in the past couple of years, certainly hasn't been the case with rising interest rates. And so with those rates locked in place, there's a liquidity crunch essentially, right? Like they can go to the seller's table. The only problem is right now, there's a lot of weird fluctuations in demand, especially with the cost of capital being so high and barriers to enter being so high, especially for first time and kind of second time home buyers. One of the things that sellers love about our platform is we can essentially go out, offer sellers the opportunity to liquidate all or part of their equity in a real estate asset without incurring, one, the 12%, 10 to 12% potential fees at the closing table on their purchase price as a seller, but also two, the opportunity cost of losing out on that accretive APR, right? And so having that, that rate locked in place, you have that 3%. As Alex said, you don't want to leave that because it's such a great opportunity, and you're certainly not going to really get that anywhere in originated debt today, at least out on a brokered market. And so being able to, one, free up liquidity, essentially feeless with Mogul as a seller is an outstanding value proposition, something that we definitely love to push. So, if you ever have a property that you're looking to sell and is kind of rent ready, or you want to continue to live in it just as you've been, come to us. We would be happy to work with you and kind of figure out a process to move forward there and actually unlock your liquidity in your equity, which is just completely unheard of in the past. And so really, really cool concept there. Essentially, that ability will allow us to achieve an incredible cost basis and pass along the benefits of that low rate and the appreciation that will continue to be achieved on the property going forward for our investors. And then in addition to that, the seller will benefit in many, many ways. A few of them being, again, that low rate exposure that they'll continue to achieve, but also that free liquidity on all or part of their equity going forward, and the ability to potentially continue to live in the home as if they continue to own it for a slightly higher premium. And that will tie into that sale leaseback model that we've talked you through in the past.
Great. Well, that actually about wraps up our questions. I know that we did more of an AMA style, kind of going back to the roots. Let me just make sure that we're not missing any of the questions in the comment section. If you did have any, just send in any questions that you might have to us, and we will answer it on next week's AMA. But Joey, thanks for joining us in the thralls of COVID out in Milwaukee. It's nice over here in DC, so we'll welcome you back to the two chairs around the fern next week. But thank you all for joining. Hit subscribe, hit like, check out the properties at www.mogul.club. Get started for $250. It's as easy as setting up an interest-bearing savings account with twice as much the return. So go check it out, and thank you.
Awesome. Thanks, everyone. And tune in next week because we'll have a surprise guest. So
yeah.
Stay